There is a shadow market sitting underneath everything you see in finance. It's not the stock market, not the bond market, not crypto. It's a 600 trillion web of contracts that most people have never heard of and almost nobody truly understands. This market already came close to killing the global financial system once, in 2008. Back then, it was only around $60 trillion in size. Today, it's roughly 10 times larger, more complex, and wired into every major institution on Earth. 2 decades ago, Warren Buffett looked at this thing and called it a financial weapon of mass destruction. At the time, many people thought he was being dramatic. He wasn't. These instruments helped blow up Lehman Brothers, forced governments to rescue AIG at gunpoint, and pushed the world to the brink of a systemic banking collapse. And the way we responded to that warning was not to dismantle the bomb, we supercharged it. Right now, the derivatives market is several times bigger than the entire world economy. Global GDP is around 100 trillion. The notional value of derivatives is about 600 trillion. That means if this system fails at scale, there simply is not enough money, credit, or political will on the planet to plug the hole. In 2008, governments and central banks had to mobilize roughly $29 trillion in guarantees, loans, and money printing just to stop the bleeding from a $60 trillion exposure. Now imagine trying to contain something 10 times that size, in a world already stuffed to the gills with debt and political anger. When this thing goes off, it won't look like a normal recession or even a 2008 replay. It will look like the operating system of modern finance crashing in real time. To understand why, we have to strip away the jargon and talk about what a derivative actually is. At its core, a derivative is nothing more than a contract whose value depends on something else. That something else can be almost anything you can measure or price: a stock, a government bond, a chunk of corporate debt, a barrel of oil, a bushel of wheat, an interest rate, a currency exchange rate, even an index of house prices, or the probability that a company will default. You don't have to own the thing you're betting on. You're just signing a contract about how its price or its behavior will change in the future. If you win the bet, money flows your way. If you lose, money flows the other way. A simple way to picture it is insurance twisted into speculation. Imagine you could buy fire insurance not on your own home, but on your neighbor's house across the street. You don't live there. You don't have anything at stake in that building. But if it burns down, you get paid. That policy is not about protecting you from loss. It's a side bet on someone else's misfortune. That is the logic that underlies a huge portion of the derivatives market. The basic building blocks have names you've heard tossed around: futures, options, swaps, forwards. A futures contract is a promise about the price of something at a specific date. Traders use it to bet on the future price of oil or gold without ever touching a barrel or an ounce. Options give the right, but not the obligation, to buy or sell something at a certain price, a way to gamble on big moves while limiting the upfront cost. Swaps take streams of cash, like fixed and floating interest payments, and exchange them, allowing banks and companies to change the kind of risk they're exposed to without changing the underlying loans. Forwards are like customized futures, private deals between two parties that don't go through an exchange at all. On paper, all of this has a legitimate purpose. A farmer who doesn't want to lose everything if wheat prices crash can lock in a price ahead of harvest. An airline that lives and dies by jet fuel costs can hedge against a spike in oil. A global company with debts in multiple currencies can smooth out the impact of exchange rate swings. Forwards are like customized futures, private deals between two parties that don't go through an exchange at all. On paper, all of this has a legitimate purpose. A farmer who doesn't want to lose everything if wheat prices crash can lock in a price ahead of harvest. An airline that lives and dies by jet fuel costs can hedge against a spike in oil. A global company with debts in multiple currencies can smooth out the impact of exchange rate swings. In that sense, derivatives can act like shock absorbers, shifting risk to players willing to take it. That's the textbook story regulators like to tell. But in the real world, the textbook is a tiny corner of the picture. The derivatives market today is not dominated by farmers and airlines calmly hedging risk. It is dominated by giant banks, hedge funds, and trading desks making enormous leveraged bets on interest rates, creditworthiness, and currencies, often with borrowed money and thin cushions of capital underneath. This is where the danger begins. The key phrase is notional value. If a bank enters into a $100 million interest rate swap, the notional value of that contract is $100 million. But the amount of money the bank actually posts as collateral might be only $1 million. That's 100-to-1 leverage. A small move in the wrong direction, 1%, 2%, can wipe out the collateral and leave the bank owing more money than it can quickly raise. Now imagine thousands of contracts like that, layered on top of each other, with different expirations, different counterparties, and different assumptions built into the math. A tiny shift in interest rates, or default probabilities, or currency values can create a tidal wave of margin calls and losses inside that web. The real horror, though, is the complexity and interconnectedness. Modern derivatives aren't simple one-to-one bets. They're often nested structures, options on swaps, tied to indexes of bonds that are themselves bundled and sliced into tranches. Even the people designing these products rarely understand every edge case of how they behave when markets are stressed. In calm conditions, the models say everything offsets. This loss here is matched by that gain there, so the net risk looks manageable. But models are only as good as their assumptions. They assume markets stay liquid, buyers can always be found, and counterparties always pay. In a panic, all of those assumptions fail at once. We saw a preview in 2008. One particular derivative, the credit default swap, was sold as a kind of insurance contract against bond defaults. In theory, if you owned a corporate or mortgage bond and worried it might fail, you could pay a premium to someone like AIG, and they would compensate you if the bond went bad. In practice, that mechanism got hijacked. Investors who didn't own any bonds at all bought protection anyway, turning it into a pure side bet on whether millions of homeowners would keep making their mortgage payments. AIG wrote hundreds of billions of dollars of these contracts, collecting years of easy premiums and setting aside nowhere near enough cash for a worst-case scenario, because the model said nationwide housing crashes basically never happen. When U.S. house prices finally did fall and mortgage defaults spiked, the derivative machine went into reverse. Suddenly, the promises embedded in those contracts were real obligations. AIG owed tens of billions it couldn't pay. Lehman Brothers faced collateral calls it couldn't meet. As one counterparty after another wobbled, trust evaporated. Banks stopped lending to each other because nobody knew who was solvent and who was already mathematically dead. That is how markets built on risk management turned into engines of systemic risk. Back then, the total notional value of the derivatives market was around $60 trillion. It took nearly $29 trillion in emergency measures worldwide, capital injections, guarantees, swap lines, and money printing to keep that system from collapsing outright. That was the dress rehearsal. Today, the same market is roughly $600 trillion, wired into every major bank, every pension fund, every insurance company, every government bond market. The financial weapon that Buffett warned about was not dismantled after it misfired. It was upgraded, multiplied, and spread across the entire planet. And the scariest part is this: Almost nobody on Main Street has any idea this is happening. Most retail investors can't define a derivative. Many professionals can't explain in plain language the derivative books their own firms carry. Yet those contracts silently determine whether your bank has enough capital, whether your pension fund can meet its promises, whether your government can roll over its debt without chaos. We're all passengers on a plane whose cockpit is filled with blinking instruments that only a handful of people claim to understand. And even they are guessing when the turbulence starts. To see how this abstract monster behaves in the real world, you have to go back to 2008 and walk through how a housing bubble became a global heart attack. The spark wasn't derivatives. It was ordinary bad lending. Banks handed out subprime mortgages to people who couldn't realistically afford them, then bundled those mortgages into securities and sold them to investors hungry for yield. That alone was dangerous, but containable. In a sane world, the losses from a bursting housing bubble would have been painful but mostly limited to the lenders and investors who took the risk. What turned it from a contained fire into a worldwide inferno was the decision to build layers of derivatives on top of those mortgages, amplifying every move. Banks didn't just hold mortgage bonds. They carved them into tranches, repackaged them into collateralized debt obligations, and then wrote credit default swaps on top, insurance-like bets on whether those bonds would default. On the way up, every link in that chain booked profits. On the way down, every link became a transmission belt for loss. Lehman Brothers was the clearest example of how deceptive that system was. On the surface, Lehman looked big but boring. $639 billion in assets, $613 billion in liabilities. A huge firm, but technically solvent. Buried in the footnotes, though, was the real story. More than $35 trillion in notional derivative exposure, built mainly on interest rate swaps and mortgage-related credit derivatives. That number didn't mean Lehman had $35 trillion sitting on the line in cash, but it did mean that the firm was at the center of a gigantic web of bets. As U.S. house prices began to fall in 2007, those bets started bleeding. Lehman's counterparties demanded more collateral, as the contracts required. The bank posted what it could, but the hole kept widening. By late 2008, nobody knew how big the losses really were, only that they were likely larger than the firm's cushion. So other banks did the rational thing in a crisis. They stepped back. They stopped trading with Lehman, stopped lending to it, and effectively sealed its fate. When Lehman filed for bankruptcy in September 2008, the immediate problem was not just that another investment bank had gone under. The real problem was that its failure instantly put every one of its derivative contracts into limbo. Institutions that thought they were protected discovered that their hedge was now a corpse. A European bank that had bought mortgage protection from Lehman suddenly had raw exposure to billions in U.S. housing losses. A pension fund that relied on Lehman to pay out on an interest rate swap suddenly had a hole in its cash flows. Nobody could quickly map who owed what to whom. The financial system discovered in real time that a huge part of its risk management layer depended on a single institution that no longer existed. AIG showed the same pattern in a different costume. This was not a scrappy Wall Street trading shop. It was one of the largest insurance companies on Earth, with roughly $1 trillion in assets scattered across life insurance, property insurance, and more. But tucked away inside AIG was a financial products division that had discovered a gold mine, selling credit default swaps on mortgage securities and corporate debt. To the traders, it looked like easy money. Housing prices had never fallen nationwide in modern U.S. History and rating agencies had blessed many of these mortgage securities as investment grade. AIG collected fees year after year and did not set aside nearly enough capital for the doomsday scenario, because the models said that scenario was almost impossible. Then housing fell, models broke, and almost impossible became last Tuesday. As defaults rose, the buyers of AIG's credit protection demanded collateral and payouts. AIG didn't have the cash. The company's credit rating was downgraded, which triggered even more collateral calls in a vicious circle. Suddenly, one of the pillars of global insurance was hours away from failure. If AIG had gone down, every bank that had bought protection from it would have taken massive, unplanned losses at the same time. The U.S. government intervened with an $85 billion emergency loan that quickly snowballed into roughly $180 billion of support. Officially, it was a rescue of AIG. In reality, it was a pass-through rescue of the banks and hedge funds that were on the winning side of those derivative bets. That is the ugly secret of derivatives. When they implode, the losses don't vanish. They either destroy institutions or get socialized. In 2008, politicians chose socialization. The U.S. government launched TARP, a $700 billion program to stabilize banks. The Federal Reserve opened alphabet soup lending facilities and eventually printed about $4 trillion through quantitative easing. Central banks in Europe and Asia rolled out their own emergency measures. When you add it all together, capital injections, guarantees, emergency loans, asset purchases, the global commitment to stop the system from unraveling was on the order of $29 trillion, almost twice the size of the entire U.S. economy at the time. All of that to contain damage from a derivatives market 1/10 the size of today's. The logical conclusion should have been obvious. If a $60 trillion derivatives market nearly wipes out the global economy and requires a once-in-a-century rescue, then maybe that market is too large, too opaque, and too dangerous to be allowed to regrow. Regulators said the right words. The Dodd-Frank Act in the United States promised reform. Some standardized derivatives would have to be cleared through central clearinghouses rather than traded privately. Reporting requirements would give regulators more visibility into who held what. It sounded like we had finally learned our lesson. But crucially, none of this really addressed the core problem. There was no serious cap on the total size of the derivatives market. The most toxic variants, like naked credit default swaps, those side bets on failures you don't actually suffer, weren't banned outright. And nothing in the rules changed the basic incentives of banks, who could still use enormous leverage, backed by depositors and implicit taxpayer guarantees, to chase profits. Lobbyists got to work as soon as the ink on the reforms dried. Over time, pieces of the new rules were weakened, delayed, or quietly ignored. Financial engineering didn't slow down, it accelerated. Within a few years, the notional value of derivatives worldwide had climbed past $600 trillion. That's where we stand now, a market 6 times bigger than the entire world economy, bound together by contracts that promise money will move in precise ways the moment interest rates, credit spreads, or currencies twitch. We are living inside a cathedral of leverage built on the assumption that shocks will stay within the bounds the models expect. The composition of that $600 trillion pile makes the risk even more concentrated. The bulk of it, over $500 trillion, is tied to interest rates. These contracts are the plumbing behind everything from adjustable-rate mortgages to corporate debt to government bond portfolios. Banks swear they use them mainly to hedge, to smooth out their exposure when rates move. But trading desks also use them to speculate aggressively on where rates will go next, because even tiny movements in benchmark rates can generate huge profits when you're working with enormous notional amounts. For nearly a decade after the 2008 crisis, interest rates hugged the floor. Central banks kept them near zero day after day, year after year. In that environment, the model said interest rate risk was manageable. Positions grew larger. Complexity increased. Then, starting in 2022, the world changed. Inflation roared back, and central banks slammed on the brakes. The Federal Reserve raised rates from effectively zero to above 5% in roughly a year and a half, the fastest hiking cycle in 4 decades. Every move reshuffled the winners and losers in the interest rate derivatives market. Some banks suddenly found themselves sitting on big, unrealized gains. Others were nursing losses they didn't want to show, using accounting rules that allow them to pretend long-dated positions will come back over time. On the surface, the system still looks calm. Underneath, it's full of stress fractures that haven't yet reached daylight. And that's only one slice. Another roughly $50 trillion is credit derivatives, including the same type of credit default swaps that almost destroyed AIG. Corporate debt has ballooned since 2008, with companies gorging on cheap loans while rates were low. Currency derivatives make up another enormous chunk, bets on how the dollar, euro, yen, and yuan will move against each other. Each of these categories is a potential fault line. Together, they create a global financial structure where a sharp move in rates, a wave of corporate defaults, or a serious shock to the dollar's status doesn't just hurt investors, it reverberates through $600 trillion worth of promises. If the sheer size of the market is the first thing that should worry you, its complexity is the second. After 2008, banks did not look at their near-death experience and decide to simplify. They did the opposite. They started building derivatives on top of derivatives, nesting contracts like Russian dolls. You can now buy options on credit default swaps, or swaps based on indexes of other swaps. Each extra layer adds another turn of leverage. A small twitch in the underlying asset can cause an outsized move in the first derivative, which gets magnified again in the second and again in the third. By the time the shock reaches the outer shell of the structure, the numbers look insane compared to the tiny change that started it. The risk models used to justify this structure look impressive. Dense formulas, Monte Carlo simulations, probability distributions. They produce neat charts that say things like, a loss of more than X billion dollars has only a 0.1% chance of occurring in a given year. But notice the quiet assumption built into all of those models, that markets remain liquid, prices move smoothly, and counterparties pay when they're supposed to. In other words, the models assume a world where the plumbing never breaks. Yet the whole point of studying crises is that sometimes the plumbing does break. Liquidity vanishes, prices gap. Institutions that were certain to survive suddenly don't. In those moments, the elegant math stops being a map and starts being a hallucination. On top of complexity, there is concentration. In the United States, roughly 90% of all derivative exposure is parked on the balance sheets of just 4 giant institutions: J.P. Morgan Chase, Citibank, Bank of America, and Goldman Sachs. These are the same names that sat at the heart of the 2008 crisis, except now they are larger, more interconnected, and carrying far more derivative exposure. J.P. Morgan alone has on the order of $54 trillion in notional derivatives. The entire bank has about $3.7 trillion in assets and only around $300 billion in actual equity capital, the cushion that stands between solvency and bankruptcy. Do the math, and you realize its derivative book is roughly 180 times the size of that cushion. When confronted with these figures, the banks always say the same thing. Don't worry, the notional value is misleading. They insist that their positions are carefully hedged, that every bet is offset by another bet on the other side, and that the true net exposure is just a tiny fraction of the headline number. Technically, there's some truth to that. On paper, if every counterparty remains healthy and every contract behaves as modeled, the gross exposures cancel out and the risk looks manageable. But we have heard this story before. Lehman's derivative portfolio was hedged too, until its counterparties stopped paying. AIG's credit default swap book was also balanced, until the downgrades arrived and collateral calls pulled the mask off. Hedging only works as long as the underlying network stays intact. When one large node fails, what looked like a neat set of offsets suddenly turns into a messy pile of raw, unnetted exposure. Citibank sits on roughly $48 trillion in derivatives, with $2.4 trillion in assets and about $200 billion in capital. Bank of America has around $37 trillion in derivatives versus $3.1 trillion in assets and $280 billion in capital. Goldman Sachs, smaller in total assets, still carries roughly 47 trillion derivatives against 1.6 trillion in assets and about $120 billion in capital. Add those four books together, and you're staring at around $186 trillion in notional exposure, almost twice global GDP, concentrated in four institutions whose failure would instantly reverberate through every major economy on Earth. The official line is that these are sophisticated institutions with world-class risk management. But sophistication cuts both ways. It enables them to build structures so intricate that no outsider, and arguably no insider, fully understands how they will behave under extreme stress. If this sounds familiar, it should. In the late 1990s, a hedge fund called Long-Term Capital Management sat at the center of a similar story, though on a smaller scale. LTCM employed some of the smartest financial minds of their era, including two Nobel Prize-winning economists. Their models told them that certain spreads between bond prices almost never moved beyond narrow bands. So they bet billions of dollars that those spreads would revert to normal if they wandered. For a while, it worked. Until Russia defaulted in 1998, spreads blew out and the fund lost $4.6 billion in 4 months. Its derivative exposures reached about $1.25 trillion, enough that the Federal Reserve orchestrated a private sector bailout to prevent panic. That was 25 years ago, when $1.25 trillion in derivatives was enough to terrify regulators. Today, our too-big-to-fail banks are holding more than 100 times that each. The network connecting these giants is not linear, it's circular. J.P. Morgan may hedge an interest rate position by entering a swap with Citibank. Citibank may hedge by trading with Bank of America. Bank of America may turn to Goldman. Goldman might go back to J.P. Morgan. On a spreadsheet, everyone thinks they have offset their risks. In reality, they have created a daisy chain where each institution's stability depends on the others not failing. If one goes down, the whole circle jolts. That was the dynamic in 2008 when Lehman fell and markets suddenly questioned the solvency of everyone else. The reforms after that crisis introduced central clearinghouses to sit in the middle of some standardized trades, supposedly breaking the chain. But most of the $600 trillion market is still made up of customized, over-the-counter contracts that never touch a clearinghouse. Those bilateral deals carry the same old counterparty risk as before, just buried deeper under legal paperwork. So the question becomes, what actually lights the fuse? What pushes this intricate, over-leveraged, concentrated system from fragile to failing? The triggers are not hypothetical. They're already forming in front of us. The first big one is interest rate volatility. Remember, more than $500 trillion of derivatives are tied to interest rates. For over a decade, those rates barely moved. Then, in 2022 and 2023, the Federal Reserve yanked them upward at the fastest pace since the early 1980s. Banks that had loaded up on long-term bonds and mortgages at low fixed rates suddenly faced big mark-to-market losses when newer bonds started offering higher yields. We saw a small, visible version of this with Silicon Valley Bank, Signature Bank, and First Republic in 2023. Their bond portfolios lost value as rates rose. Depositors panicked and the banks failed. But hidden behind the scenes are derivative books that are experiencing similar pain. Only the losses aren't fully recognized Because accounting rules let institutions pretend long-duration positions will recover if held to maturity. Now imagine the Federal Reserve stuck in a no-win scenario. If inflation remains stubborn, it keeps rates high or even raises them further, deepening losses for anyone who bet on low, steady rates. If the economy tips into recession and the Fed cuts aggressively, the losers shift to the other side of the trade, institutions that had positioned for higher for longer. Either path creates casualties. The riskiest path of all is a zigzag, raising, then cutting, then raising again as political and economic pressures collide. That kind of whipsaw volatility is toxic in a market where even small changes in rates can reprice hundreds of trillions in contracts. Commercial real estate is the second potential trigger. Office towers in major cities are still half empty after the shift to remote work. Over $2 trillion in commercial mortgages must be refinanced in the next couple of years at interest rates 2 or 3 times higher than the loans were written. Many properties simply don't generate enough rental income to support the new payments. Defaults are not a question of if, but how many and how fast. Those defaults will hit the holders of the loans, of course, but they will also activate credit derivatives written on commercial mortgage-backed securities. Institutions that sold protection on those securities, betting that default rates would stay low, will owe real cash at the worst possible time. Tens of billions in derivative losses in that niche alone won't collapse the global system, but they can weaken already stressed banks and start the familiar cycle of distrust and funding freezes. A third stress point runs through Europe. In 2023, Credit Suisse finally collapsed under the weight of years of scandals and losses, forced into a shotgun marriage with UBS. Around the same time, credit default swaps on Deutsche Bank spiked as markets briefly questioned its survival. These are not small players. Deutsche Bank carries tens of trillions in derivative exposure. When investors doubt the solvency of a bank like that, counterparties begin to step back, and the whole network tightens. An outright failure of a major European bank would not stay in Europe. The derivative web would transmit the shock instantly to New York, London, and Hong Kong. JP Morgan's risk is not just American mortgages and U.S. treasuries, it's also every foreign bank it has traded with, every sovereign it has written swaps on, every corporate bond portfolio it has hedged through derivatives. Beyond those immediate cracks lies perhaps the most dangerous fault line of all: sovereign debt in major economies: Japan, China, the Eurozone, and the United States itself. These are not fringe markets. They are the pillars on which the derivative edifice rests. If one of those pillars starts to crumble, the contract stacked on it will move in ways nobody's model can handle. Sovereign debt is where all of these threads knot together. Take Japan. Its government debt is more than 2.5 times the size of its economy, the highest ratio in the developed world. For decades, the Bank of Japan kept interest rates near or below zero, effectively freezing the cost of that debt in place. But inflation and global rate pressure are slowly pushing Japan toward a choice it cannot dodge forever: raise rates and risk a fiscal crisis, or keep them pinned low and risk a currency crisis. Either outcome is poison for derivatives. A sharp rise in Japanese yields would hammer the price of government bonds and trigger losses across countless interest rate swaps and bond futures. A collapsing yen would rip through currency derivatives. The trades that looked safe because Japan never changes would all move at once. China is different, but just as fragile. On paper, Beijing's official debt numbers look manageable, but a huge amount of borrowing lives in shadowy local government financing vehicles and state-linked corporations. Much of that money was poured into real estate, the giant apartment complexes and ghost cities that defined the boom years. That boom is now unwinding. Developers like Evergrande and Country Garden have defaulted on hundreds of billions of dollars in obligations. Apartments sit unfinished, buyers are angry, and local governments that depended on land sales are starved of revenue. Behind the scenes, Chinese banks and insurers sold and bought derivatives linked to this debt. Credit default swaps on property companies, structured notes linked to real estate indexes, currency hedges tied to capital flows. If the Chinese financial system experiences a full-blown crisis, the pain will not stay inside its borders. Western banks that wrote or bought protection on Chinese debt will discover that their diversified exposure to emerging markets is really another strand of the same global web. The uncomfortable truth is that the next derivatives crisis will hit a world that has already used up much of its emergency capacity. In 2008, when the subprime bubble burst and derivatives transmitted the shock everywhere, governments and central banks responded with an unprecedented rescue. In the United States, Congress authorized the $700 billion TARP program. The Federal Reserve expanded its balance sheet from about $800 billion to the multi-trillion range through quantitative easing, buying bonds and mortgage securities to inject liquidity. Around the world, other central banks and treasuries added their own bailouts, guarantees, and loan facilities. When you tally the commitments, direct and indirect, the total comes to roughly $29 trillion, about 40% of global GDP at the time. That ocean of money, plus years of near-zero interest rates, barely kept the system from imploding. Now, fast forward to the present. Global GDP is about $100 trillion. The derivatives market is roughly 6 times that size. If only 5% of those contracts go bad, you're looking at $30 trillion in losses, already greater than the full rescue effort of 2008. If 10% go bad, the bill climbs to $60 trillion, more than half of world output. Meanwhile, the major governments that would have to orchestrate another rescue are already buried in their own debts. The United States owes around $36 trillion. European countries carry loads that in some cases exceed their entire GDP. Japan is off the charts. China's hidden liabilities are enormous once you include local governments and state firms. These are not balance sheets with room for another multi-trillion-dollar emergency. Technically, central banks could try the same trick again, print money. The Federal Reserve's balance sheet ballooned to around $9 trillion during the COVID era. That wave of liquidity helped keep markets alive during lockdowns, but it also fed the worst inflation Americans had seen in 40 years. We all felt that at the gas pump and the grocery store. If the Fed tried to create another $10 or $20 trillion from thin air to plug derivative losses, the inflation shock would be far more brutal. The dollar's purchasing power would erode rapidly. Import prices would explode. Savers and retirees would see the real value of their money evaporate. At some point, a financial rescue morphs into a currency crisis, and a currency crisis is harder to escape because every citizen is trapped inside it. Even if the math somehow worked, the politics almost certainly wouldn't. In 2008, the public was angry but still willing to accept the argument that banks had to be saved to protect the system. They watched bonuses return to Wall Street while their own wages stagnated and their home values cratered. 15 years later, the mood is very different. Trust in government is low. Populist movements on both left and right have built their identities around opposing elite bailouts. Any attempt to shovel trillions toward large financial institutions again would meet a wall of resistance. Protests, lawsuits, legislative blockades. The doctrine of too big to fail has quietly transformed into too big to save. The institutions are larger and more complex. The patience of ordinary citizens is smaller. There is another, more subtle reason why bailing out derivatives doesn't work the way bailing out bad loans once did. When a bank holds a toxic mortgage, the government can step in, buy the loan, and slowly recover some value as the housing market heals. There is a house, dirt, bricks, something real sitting underneath the number on the screen. A derivative is different. It's a bet between two parties. When one side loses, the other side wins. If the state steps in to make the losing side whole, it is not saving an asset, it is transferring wealth to the winning speculator. There is nothing productive being rescued, just a contract. Try explaining to an angry electorate why their tax money or the purchasing power of their savings should be sacrificed so that hedge funds and megabanks on the winning side of an interest rate bet get paid in full. Layered on top of all this is opacity. In crises, time compresses. When Lehman failed, it took months and armies of lawyers to unwind its contracts and figure out who owed what to whom. That was one institution in a $60 trillion market. Imagine trying to map the exposures of multiple failing banks inside a $600 trillion market full of bespoke, over-the-counter instruments, cross-border subsidiaries, and complex netting agreements. By the time regulators even understood the shape of the whole, the real economy, jobs, factories, supply chains would already be in deep freeze. You cannot effectively rescue a system you literally cannot see in real time. So we arrive at an uncomfortable conclusion. We are sitting on a financial structure that is larger, more leveraged, more interconnected, and more politically toxic than anything that existed in 2008. The same warning that Buffett gave 2 decades ago, that derivatives are financial weapons of mass destruction, has proved accurate more than once. And yet, the world's response has been to keep building bigger stockpiles. Every major trigger we've discussed, violent rate moves, real estate defaults, European banking stress, sovereign debt fractures in Japan or China or elsewhere, already exist in some stage of development. The question is not whether one of them will snap, it is when and in what order. When the snap comes, the chain reaction will not wait for committee meetings. One large institution will miss a margin call or fail to deliver on a derivative contract. Counterparties that thought they were hedged will realize their insurance just vanished. Clearinghouses will be hit with losses they were never capitalized to cover. Funding markets will seize as banks stop trusting each other's balance sheets. Within days, credit cards may stop authorizing, ATMs may limit withdrawals, and payrolls may be delayed as banks are pushed into resolution or nationalization. Pension funds will see losses so large that retirement tables no longer make sense. Supply chains, already fragile from years of geopolitical stress, will jam as working capital dries up. Ordinary people who never bought a single derivative will feel the shock in the most basic parts of their lives. The job they lose, the payment that doesn't arrive, the price that doubles overnight. This isn't about predicting an exact date or selling fear. It's about recognizing scale and pattern. A 60 trillion derivative system dragged the world to the edge once. We now live with a 600 trillion version of the same machine, with weaker governments, angrier populations, and fewer tools left in the box. You can't vote that away in a single election, and you can't tweet it into irrelevance. What you can do is stop pretending the risk doesn't exist. You can treat the next 20 years not as a straight line from today's comfort, but as a period where the rules of the game may change suddenly. For some people, that will mean rethinking how much of their future depends on financial promises that can be broken, pensions, fixed incomes, single-country banking systems. For others, it will mean diversifying where they live, work, and hold their savings. For everyone, it should mean paying attention to the quiet, technical stories about derivatives, interest rates, and bank balance sheets, because those stories are the tremors before the quake. History rarely gives us such a clear view of the explosives under our feet. This time, it has. The 600 trillion derivatives market is not an abstract curiosity. It is the hidden architecture of the world we live in, an architecture built on the assumption that counterparties always pay and that governments can always step in. If either of those assumptions fails, the world after will look very different from the world before.